What's up guys, and welcome back to Wall Street Millennial. Today we're doing another video in our options strategy series. Specifically, we're going to go over the Iron Condor strategy, which is a way to bet against market volatility. If you like this content, make sure to smash the like and subscribe button. Now let's get into the video. So what is the Iron Condor? The Iron Condor is made up of 4 options. To create an Iron Condor, you sell one call and put, which are both pretty close to in the money. You then buy one call and one put that are farther out of the money, and these are called the wings. Remember that when you buy an option, you pay a premium, and when you sell an option, you get paid the premium. The closer the option is to being in the money, the higher the premium. Because the options you sold are closer to in the money than the ones you bought, you actually collect a net premium by initiating the Iron Condor position. Let's look at a simple example to understand this. Let's say a stock is currently trading at $100. You sell a call and a put, each $5 out of the money. You then buy a call and put, each $10 out of the money. The 105 strike call and the 95 strike put are worth $1 each, and the 110 strike call and 90 strike put are only worth 50 cents each because they are farther out of the money. The options you sold are worth $2 total, and the options you bought are worth $1. So altogether, you get paid $1 to initiate the position. So now that you've built the Iron Condor, what happens? You're betting against volatility, so the best case scenario is the stock price does not move. To explain this, let's go back to the simple example. If the stock stays within the range of the 2 options that you sold, in this case $95 to $105, the net payout of the options is 0, and you keep the $1 you made as an initial credit when you opened the position. If the stock moves outside of this range, you will lose money, but your losses are capped because you bought the wing position to cover your risk. So the maximum you can lose is $5. But remember, you got paid $1 for opening the position, so maximum net loss is $4. In this case, your max loss is 4 times greater than your max gain. So for this strategy to be worth it, you have to believe there is at least an 80% chance the stock will stay within the $95 to $100 range. Now we'll look at a real example of how to implement the Iron Condor strategy in Robinhood. At the time of this video, NEO stock was trading around $55.20. If I had a belief that NEO stock was likely to stay around this level, I might consider initiating an Iron Condor position. To do this, I would sell a slightly out of the money call and a slightly out of the money put. In this case, selling a 56 strike call and a 55 strike put would credit me about $2.05 plus $2.31, which equals about $4.36. Then, buying a 57 strike call and a 54 strike put would cost me about $1.85 plus $1.68, which equals about $3.53. So I would receive about 83 cents for initiating this position. If the price of NEO goes below $55 or above $56, I start losing money until it reaches either $54 or $57. At this point, I would lose $1 at expiry, which would mean that I net a 17-cent loss considering the premium that I received from initiating the position. But this only happens if my thesis is wrong and the price of NEO moves far enough away from the current price. The Iron Condor strategy is a great way to bet against volatility. The higher the implied volatility of a stock, the greater the initial credit you will receive for initiating the position. So if you think implied volatility is too high, it can be profitable to use the Iron Condor. If you are unfamiliar with implied volatility, make sure to check out our other video, link in the description below. As always, we thank you for your support, and Wall Street Millennial signing out.